We start today's market talk. Much analyzed unwinding of yen carry trade turned out to be a storm in a teacup, and investors jumped back into the market this week all across the world. And this is what Keynes had said: live with some uncertainty. He said that in all fields, behavior would be significantly changed when the participants acknowledge that there is uncertainty in information. Market outlook. Investors jumped back into the market this week, doing what they have been doing for years now, enthusiastically buying the dip. So the USD JPY, that is yen, was back above 148 from 140 level, and the CBOE VIX cooled down. S&P 500 and Nasdaq are higher than when the US non-farm employment numbers were released. So the dip was bought. And as respect to our markets, I'll just show you uh, here the difference. If you see the post-market summation of August 16, the the major difference is that the market-wide position limits from 43.57 came down to 42.91. That means 0.6% of the positions were reduced. So it was basically short covering, which resulted uh, in the rise in the indices on Friday. So we'll have to see what happens from here. US fund futures are pricing in a 70% probability of a 25 basis point rate cut at the next Fed meet in September, but only a 30% probability of 50 basis point cut. So the US retail inflation data showed that both headline and core inflation continued to cool, while lower initial claims for unemployment benefits reduced worries about weakness of labor markets. US retail sales too came in better than expected. So the panic is generally over, and the markets are now looking forward to an orderly series of rate cuts from 5.25 to 5.55, 5.5, which is presently, to 3.75 to 4 by March 25. That is a total of around 25 basis point cut in next 6 months starting September. Current market valuations are driven by deluge of domestic liquidity and financialization of savings. Main drivers of valuation is financialization of savings, that is direct, all those people who are directly putting money in equities, and indirect, that is through mutual funds, and formalization, where pension funds, EPFO, uh, and others are putting the money in equity markets. Now, a significant event this week was Ola Electric IPO. Now, they came up with their Q1 FY25 results also. Now, the IPO had a strong start, but profitability remains elusive. Uh, E-two-wheelers market, they are now having 49% market share. But the tapering of FAME subsidy has seen the demand for electric vehicles showing a decent decline. And also, Hero, Bajaj, and TVS are taking aggressive steps in their EV portfolio. FY26, they are expected to do 8,000 crore revenue, and it is presently trading at roughly 7 times price to sales. That is, right now, it is at around $7 billion valuation. So it seems to be now expensive. Now, among the two stocks which I feel are direct beneficiaries of the consumption play in both urban and rural areas. First is urban areas, it is Trend. The industry leading show of Trend continues. They had healthy like-for-like growth in existing stores as well as store additions. It is likely to be in the Nifty next month. Revenue grew 57% year on year, double-digit like-for-like growth. Westside and Zudio performed well. Loyalty program West Style Club has 1.09 crore members as of March 24. It registered strong results year on year. Sales were up 57%, EBITDA margins up 90 basis points, adjusted PAT up 130%. FY26 expected EPS is 73. At 90 to 100 times, it can easily trade in between 6,300 to around 7,300. It is increasing its digital presence. 5% of its revenues are coming from digital presence. And it is coming into beauty, personal care, and innerwear. That is a new segments it is launching. So it is getting into the field of page industries. The rural play could be played through Hero MotoCorp. Stable commodity prices, good monsoon, increased common spending in rural areas is a tailwind for company. Focus is on premium bikes and electric vehicles, which will be the growth drivers. Net profit was up 36% year on year. EBITDA margin was up 59 basis point. Revenue was up 15.7% year on year. FY26, 50,000 crore sales is expected, and 274 EPS is expected in FY26. So giving it a PE of around 20-25 times. Price of 5,500 to 6,000 is possible. Now, if you see the weekly statistics, Nifty was up 0.7%, while Bank Nifty was lagging, was up nearly flat. Gold rose because the dollar weakened. Silver also rose. Crude oil was generally flat. Natural gas and dollar corrected. USD INR was slightly, uh, price went up, so slightly strengthened. 10-year bond yields also came down slightly. NSE market cap was up 0.32%. That means the mid caps and small caps underperformed the Nifty. Market-wide position limits was overall up 1.24%, so which is normal as the contract proceeds. Dow Jones was up 2.94%, Nasdaq was up 5.38%, and S&P 500 was up 3.93%. So coming to US economic data on inflation, retail sales, and comments from Walmart reduced the economic slowdown fears and gave confidence to investors. So after the strong economic data, the bond yields rebounded. They were correcting in a big way because there was expectations of an emergency big rate cut. But then they rebounded and now they are trading above the 100 EMA of 3.8. So they have reached around 3.8 or 3.9 levels. So, but they are expected to remain at these levels, and this is to be watched. The dollar index also was weak now and has come down to 102 because the yen has strengthened against the dollar. So that is also one of the reasons. Brent crude price is going down despite the rate cut expectations and all. Basically, the prices are going down because the expectation is that China's economic progress is going to be slow. So the growth is not going to be there. Hence, expectation is that the demand will be low. Gold is now going up. It has touched 2,500 levels. And if you plot the Fibonacci extension, it is expected to short term go to 2,700 and then 2,850 levels. So keep a watch on this. Copper strengthened slightly. It had broken below the 100 EMA. It bounced back there, but there is no super cycle as such because there is enough inventory now. So it will just remain at these levels. Nasdaq had a strong week, was up 5.38%, and it came down on the weekly charts, came down to 50 EMA, and then has bounced back, and now it is higher than the levels it was in the week before that August 5 fall took place on because of weak economic data. Now coming to Indian markets, the India VIX declined over the week. Now you can see how it has been declining and it is making lower lows now, and it should decline now back to this 10, 11 levels from the spike it had taken place in first week of August. Common bond yields were also lower. Nifty, if you see here, it had a green candle, was up 0.71%. It is trading above the election day high, and significantly above the 20 EMA also. It is trying to cover this gap which was here. Let's see the daily chart. It has gone above the 20 EMA, and if it trades above the 20 EMA, then it will be strong. It is trying to fill this gap. So we'll see. Basically, the whole week was generally flat, and it was threatening to break the 50 EMA, that all the 24,000 level. But Friday improved the sentiment across the week. Nifty put itself up to finish near the top of the week's trading range. Uh, Now let's see on the 30 minutes chart. So if you see here, after the fall on August 5th, it is having a gentle upward slope to recovery, uh, creating higher bottoms along the way. Will there be follow-through action that can carry Nifty towards this second gap? Because right now it is in this first gap which was formed. So if it goes above this gap, where these gaps it will face some resistances, then it can conquer that 25,000 mark again. Failure of first gap area, where if it takes place now, then it will retest this trend line support which is there, or the moving averages. I'm skeptical because the banks are struggling. I'll show you the banks also. This is Nifty Bank. It is still below this election day level, and it made a kind of a doji on the weekly chart and on the daily chart. So if you see here, it was generally at the same level throughout the week, and though it bounced back from the 100 EMA. For on Thursday, on Wednesday, it traded below the 100 EMA also, and after expiry, it has bounced back. Let's see on the 30 minutes chart. It has, so if you see throughout the last week, uh, we don't have a higher bottom. So what is happening is that generally the level is the same. So there is no as such a positive trend. And this gap is there where it uh, faced resistance and came down from at around 50,750. So firstly, this gap will have to be conquered. And then there are swing highs which are there, uh, which will provide resistances. So till the time Nifty Bank is weak, probability of Nifty going up is less. If you see the Bank Nifty to Nifty chart, the Bank Nifty to Nifty ratio now fell to the lowest after 7th March 2024 to around 2.05 level. So watch this level carefully. And because of this downward trending trend, so despite strength in Nifty, the Bank Nifty has been not been able to keep pace. This is about performance of financials. So if you see here, vis-a-vis Nifty, the financials have been underperforming, and Nifty was in the last 4 week was up around 0.55, but the financials have been lost nearly on an average around 5% in the last 4 weeks, and they have underperformed over last 12 weeks and 20 weeks also. So all kind of financial, whether banks, NBFCs, and of all types have been underperforming. Housing finance, consumer finance, gold finance, everything is underperforming except Muthoot and Bandhan Bank. So watch out for this. Uh, One of the main reasons Nifty was able to sustain was HDFC Bank. This it had a fall. This is a daily chart after the MSCI data came in, where the anticipated amount which was supposed to come is below the expectation. So it fell. It fell from that 1660 odd levels. There's a gap here, and fell down to around 1600 levels. But now it has taken support here. So it seems to be making a higher low. So let's see where it goes from here. There is some buying which is emerging here. Now it is above the 20 EMA. Reliance broke this supply zone, or as such, whatever you may call it, broke this 2960 level, went below that, went to 28,880, and has generally risen from there, and is now testing this gap. If it can trade above that, then it will trade above 3000, and then it can go up. Otherwise, if it faces resistance, it will test the lower support at 2840 odd levels. The stock which was in momentum was TCS. TCS has retesting the top of 4,400 it had made. And if it closes above this 4,400 level, then it can go to 4,700 level, because it made a low of around 4,100 from here and has risen 300 points. So generally, if it goes up in momentum and there would be short covering, it can go another 200, 300 points from here. So it is IT which is in momentum, and there is good action which is seen in IT, and that is because of revival of trend in the US. So here, if you see over a weekly chart, it has made a decent cup and handle, and now it has broken out, and it corrected after the US economic data, but then has bounced back, and it has not broken any technical support. So if it bounces back up above these levels, it can make fresh new highs. Midcap index is trying to fill this gap. It had a positive green week, trying to fill this gap which was formed, and it is above the election day high. Similarly, is the small cap index, we're up 0.14%. But as Nifty sustains at these levels, there would be some more positive sentiment. So basically, if upside gets confirmed, then buy some intraday dip, or dip, so that you get some better price, but don't chase breakouts, because it can easily fail right now, because there are a lot of resistances for both Nifty and Bank Nifty. And in event of failure, buy only on supports which have been made for the last 2 weeks. Now I'll cover three stocks today. First is Honasa Consumer, the owner of brand called Mama Earth. It had a strong revenue performance, 19% year on year and 25% year on year UVG, that is underlying volume growth. It was led by faster growth in emerging brands, market share gain in face wash and shampoo, and aggressive distribution expansion, 30% year on year. Go-to-market transformation continues to track well with 80% completion in first two phases, direct distribution in top 50 cities, and distribution management system has been established with 60% completion in enhancement of supply chain capability. Most of the newer brands are tracking well. However, it is discontinuing Ayuga. Mama Earth continues to outperform top 15 brands in beauty and personal care with market share gains across channels and categories. It has gained 115 basis point value market share in face wash and 51 basis point market share in shampoo. Uh, the Therma, the Derma company, TDC, is scaling up well. The Derma company is into skin solutions as such. So, doing well with expansion into offline distribution with continued improvement in profitability. Be Blunt, which is basically provides uh, salon experience at home, scaled to an ARR, that is annual recurring revenue of 100 crore in Q1 FY25, grew 4x plus in 2 years since acquisition. It has launched LUPs, that is low unit packs, that is kind of sachets in key categories of face wash 50 ml and shampoo 100 ml. Healthy operating profit margin expansion and offline distribution scaling up well with steps in the right direction. It has opened around 2 lakh outlets, and hence the inventory management becomes a key issue. Let's see their Q1 numbers. They did around 19% revenue growth, 57% EBITDA growth, and net profit was up 63%. just because the EBITDA is growing better, so it is coming into profits, and EBITDA margins are up around 200 basis points, which is very nice. Next is their profit and loss. So if you see, they're projected to do a net sales of around 2,800 crores in FY26 with margins of 10.5, and expected to do a profit of 250 crores. So what is expected is they will have a EPS of around 7.8 and net sales growth of around 22%, EBITDA growth of 51, and EPS growth of around 50%. So this is what is inspiring confidence. And present valuations, if you see, price to sales is around 5.4. ROE, ROC, that is the profitability ratios, are also improving, and they are now in high double digits. So which is good, and all operating ratios are improving for them. Revenue and growth CAGR was 80%. Now it is 21% growth rate is expected to take them to around 2,800 plus revenue, 2,800 crores revenue. Advertising and promotion expenses as percentage of revenue are still high, but this is operating expense, so it is expected to be around 33%. EBITDA margins are reaching 10%, and EBITDA and growth rate is around 47%. So they're expected to do an EBITDA of 296 crore, so which is good. Now, seeing that chart, they are at these levels only right now, but it is after making a low in March, it is trending upwards. So anywhere close to these moving averages from 464 levels to around 444 is a good opportunity to accumulate this stock. The next stock is Signature Global. It has become one of the leading real estate developers in the Delhi NCR market. The company commenced its journey in the affordable and low middle income housing segment by leveraging the state government's housing policies. Uh, they were direct beneficiaries of Haryana's affordable housing policy and Deen Dayal Jan Awas Yojana. Through its standardized offering and quick turnaround strategy, it has scaled up rapidly and delivered 42% CAGR in pre-sales over FY21-23. It has forayed into the premium segment, which doubled its pre-sales to rupees 7,300 crores in FY24. The initial two premium projects received strong response with 85 to 100% of units booked during the launch period. Strong execution capabilities have enabled it to churn the capital and gear up with a strong 30 million square feet project pipeline to be launched over the next 2 years. Expect the growth momentum to remain intact and expect it to deliver 35% CAGR in pre-sales over FY24 to 27, roughly around 17,800 crores. The management's disciplined land acquisition strategy has enabled it to curtail costs and report margins of over 35% better than peers. It has gained access to strategic locations like Sona Road, SPR, and Dwarka Expressway. SPR is Southern Peripheral Road in Gurugram, uh, which will witness both volume and realization growth. Sona Road, SPR, and Dwarka Expressway. So these are the key locations where it is working on. Now, seeing their numbers, they had weak years in FY22 and FY23 and 24, where the PAT and the profits and revenues were declining. But they have restructured themselves, and now they are getting into premium real estate from affordable housing, and they are expected to grow their revenue to roughly 5,000 plus crore in FY26. EBITDA margins are also expected to improve to 23% plus, and they are expected to do around 665 crores of profit in FY25 and 972 crores in FY26. This is a balance sheet. Their debt is reducing, so which will help their balance sheet, and also it will flow into their income and expenditure by reducing the uh, finance cost. If you see their ratios, they are expected to do around 47 rupees EPS in FY25 and around 69 in FY26. So which gives them a P of around 21 at present. It can easily trade at 25 to this level of P. So let's see. Return ratios are expected to improve and leverage ratios are also good. So it's not very expensive. Now, it is basically focusing on three micro markets, sector 71, 17 million square feet, which has got 71. This is this proximity to all prime areas of Gurugram, red light area, red light free to golf course road in future. Second is Sona Elevated Corridor Area, 7.2 million square feet. It commenced in 2022, closer to Cyber City and MG Road than parts of Gurugram. Sector 37D, 6 million square feet, Dwarka Expressway inaugurated in February 24 by Honorable Prime Minister. Strategically exposed to all emerging micro markets. So established micro markets in this Gurugram area, MG Road, Golf Course Extension, Gurugram. So they are in Golf Course Extension area. These are high-end and ultra-luxury areas. Then emerging micro markets are SPR, Dwarka Expressway, New Gurugram and Sona Town. They are in all these four. This is affordable in mid-end. So this is in that 5 crore to 10 crore category. They are focusing on this area because they know that they cannot compete with high-end luxury. The launches are expected to increase by 4x in FY25. Pre-sales to grow at 35% CAGR over the next 3 years. They will deliver good growth in operating cash flow, and net cash balance will also improve, which will reduce their debt. Revenue will improve around 105% CAGR in top line, and EBITDA could increase to 1,300 crore with 25% margin. They have strong project pipeline. Sector 71, 37D, Sona Corridor, Manesar, and others with 32 million square feet. As per their scenario analysis for bull case and bear case, to see as per their expected level of performance, the target price for bull case is around 2,300 and bear case is around 1,500. Generally, it is somewhere in between. So 1,800 to 1,900 should be a easy target for this stock. So presently, it is at bear case forward valuation. Let's see the chart. It has been subdued after listing, but now it is on an upside. So somewhere anywhere close to the 50 moving average where it has consolidated over the last uh, week plus should be a good level to accumulate this stock. Last stock today is HUDCO uh, with a 15% loan CAGR, 28% disbursement CAGR, NIMS of 3.5, leading to a 17% EPS CAGR during FY23, FY30 expected, and translating into 16% ROE and 3% ROA by FY30. It would be a proxy play on India's infrastructure and housing story. Given Government of India's continued focus on affordable housing, budgetary allocation over time has focused on housing. It's financing the Maharashtra Housing and Area Development Authority and construct houses for economically weaker section. It assists state governments and its agencies in urban planning activities of infra projects, sewage, drainage, water supply, smart city development, and road and transport assets. Effective liability management backed by sound asset liability match, high share of tax-free bonds, that is because of Navratna status, foreign borrowing 60 to 70% price lower than blended cost of funds, and focus on high yielding infrastructure financing assets could drive an improving margin profile to 3.9% by FY30. Protracted NPA down cycle, accelerating NPA resolution. This is one of the few NBFCs where the NPAs are expected to go down, and NPA and right now they are fully provided. So in case the NPAs are resolved and then the provisions are written back, it will directly flow into profits. 97% of the loan exposure is to state finances. So it is less risky as compared to others. If you see their financials, they are expected to do around 3,700 odd net interest income crore net interest income in FY26 and gross income of 3954, 3,954 crores, with the PAT, profit after tax, of roughly around uh, 26,884 crores. The balance sheet is decent. They are expected to do an EPS of around 13 rupees in FY26, and adjusted book value is 110 rupees. So you can remember this and judge it accordingly. NIMs are expected to improve. Gross NPAs are asset quality is improving and it is coming down. Now it is at 2.2, and expected loan growth is 15.7%. So it is improving. Uh, ROA is also improving. Now it is reaching around 2.5. So if you see 15% loan CAGR and 17% EPS, you can project it for next 4 5 years because of the political continuity. So growth is expected to improve over the next, but go to 15.7% in FY26, disbursement growth of 30%, net interest income growth of 18%, PAT growth of around 20%, which is going to continue. So it is expected to have a AUM of around 2,20,000 crore by FY30 from presently. So that AUM is expected to double over the next uh, 3 4 years. So which is strong, and EPS will also automatically improve. Uh, ROA is expected to be around 2.5, with interest income, net interest income, and pre-provisioning profit are going to be stronger and improving. So if you see, it is expected to do better over the next few years and become stronger as a part of, and ROE is also improving and ROA is also improving, which will directly flow into profit after tax. Now, infra financing portfolio consists of roads and transport, water supply, power, commercial infrastructure, social infrastructure area development, and emerging sector. Ticket size is under to 300 crore. Yields are higher for power projects, from 9.5 to 10.25, and slightly lower for others. Uh, Loan tenure is long, 10 to 15. So, an LTV, loan to value, is around 80%, and percentage share in AUM is majority share. They have diversified loan product offering, housing finance, infrastructure financing, consultancy, knowledge partner, and role in government flagship programs like PMAY, Awas Yojana of both urban and rural, smart city, and Swachh Bharat, Jal Jeevan Mission, etc. Plus, they're providing support, financing partners, and value-added services, etc. for all kind of infrastructure development of Government of India. Let's see their chart. It was below 100 odd levels by end of this year, and then the growth has started. And major impetus has been there post elections, after there has been an increase in allocation of PM Awas Yojana. It made a high of around 350, 360 levels, and then it has corrected. If you see, the FY26 is expected to be 110, is expected to be the book value. So at around 2.5 times, it should be reasonable. So if it comes to around this 260 level, it should become attractive. Right now, it is consolidated along the 50 EMA. So let's see where it goes. I finished. We will take questions now.